welcome to the Monday Futures Market Outlook for March 26, 2012. This is Patrick Sresna. For those of you that have not had the opportunity to try out eMiniSource.com's live trading room, complimentary memberships are available on the website. As always, we start off with a chart of the US dollar index futures, which is the US dollar as it trades against a basket of currencies. And we've seen over the last 2 weeks some weakness in the US dollar as it's coming off some of its highs. We're at a key level right around this 79 and change level where if there's a chance that we may actually wedge and potentially even become bullish on the US dollar off this level. If this level on the downside is broken, we may first need a retest of the previous lows around that 78, 78.50 for a double bottom. So we're watching where this initial support line really develops. In the bigger picture, we suggested we are a longer term bullish the US dollar, and we're not changing that theme. It's just a matter of waiting to see where and how the US dollar bangs out its short-term bottoms. Next year, we're going to take a look at the Euro FX futures, and the Euro is at a key level around this 133, 134 level. If it rejected here, it would almost be like a head and shoulders pattern, inverse of what we saw in that US dollar. But in the same regard, if the Euro was able to strengthen through this level, it may lead to even a double top retest along that 135, 136. Obviously, a new Euro down move has not grabbed hold yet, neither has the US dollar becoming a new clear uptrend. So we're waiting to see how these currencies continue to finish banging along these support resistance levels, and we'll look for a bigger picture trend to develop once they finish playing this trade range out. Next year, I want to take a look at the 30-year Treasury bonds, and one thing we obviously saw was a substantial breakdown in 30-year Treasuries the other week, and we now have gotten a bounce, and we were suggesting that a bounce could easily come back towards this 138 to 139 level on the upside. This is an interesting point where the Treasury bonds could roll over here and come for another sell cycle down to the bottom of those ranges. As we see another round of weakness in the Treasuries, we're going to be looking to see whether or not they start putting in short-term bottoming formations, or whether or not it'll be a very clean resumption and downtrend. If we had any breakdown of the 135 level with momentum, certainly there would be room for Treasuries to even trade down toward 130, and that's not necessarily our forecast, but we're certainly going to be watching the way a new wave of selling plays out. In the same regard, if we saw double bottom retests of the 135 level and no follow through selling, in fact that may be where the short-term bottoms come in. So we're going to be watching. We still anticipate that Treasuries won't V-bottom, which means that they probably have to at minimum retest those previous lows before some new technical information emerges. Next year, I want to take a look at copper futures, and we really at this stage are seeing copper trading distinctly in a sideways range-bound environment. Overall, while copper continues to trade in the sideways range, we've been looking to see whether like a double top would have triggered a breakdown of that 370 level on the downside. That breakdown never occurred. At this stage, we look at copper very much in a neutral manner until we have some sort of a bearish confirmation of a breakdown. So we're watching here to see whether or not it manages to trade right back to the top end of that range around 394. If for whatever reason we had a substantial rally in the euro and a breakdown of the US dollar, it may lead to a short-term spike in commodities, which could, and we certainly would not rule out the possibility of copper maybe trading up to a 420 level. But again, we'll cross that bridge when we see some follow through on the upside on copper prices. But we certainly don't want to become bearish until we see the technical break of that blue line we drew in around that 370 level. Next year, I'm going to take a look at crude oil, and crude oil has been technically creating a very interesting pattern. Overall, we've seen almost all the selling on crude oil being contained, and it's been contained to higher highs. If you look at where back in November, December, and January, all the major highs of crude oil came in around that 101 to 103 level, and we really at this stage are seeing that that almost all selling is contained above that level. And so there is definitely room for crude oil to potentially bullishly break, so long as there's no breakdown in the price action. So the way we kind of look at it is that it would take a substantial break of crude oil down to the 101 to 103 level, and then particularly through that level on the downside, to technically change the uptrend of crude oil. So long as crude stays at these levels, and eventually when it breaks above the 108 level, or if it does break above that 108 level, that would indicate that there's potentially a new buy cycle coming in crude. If we saw any strengthening above 108, let's say go up to 109, 110, there would be room for that to bullishly break, and probably test anywhere from the 113 to even 118 level on the upside. So we're watching whether or not crude technically breaks that level. If it does, then we may see some short-term follow-through on the upside. Next here, I want to take a look at gold futures, and gold is at an interesting juncture. We really are right at the bottom end of the retracement levels. We were suggesting that this wedge, in order for it to be potentially a wedge that could see a bullish move back to into the mid 1700s, that we would need to see the 1630 to 1640 level hold. Up till now, the gold has made a number of tests of this zone and has failed to break through it on the downside, and therefore we have to look at the possibility that maybe gold may have a short-term pop back to 1700 to 1720 on the upside. So there's definitely room for maybe even $40 or more on the upside of gold up to some overhead resistance. At that stage, depending on some of the bigger picture currency moves, we can determine whether or not there's any room for gold to follow through even further from that point. But really at this stage, we're just going to see whether or not that support line holds, and whether the gold bulls can muster up a push above 1700. That brings us to wanting to take a look at the stock markets, and we always start with a weekly chart of the S&P 500 going back 3 decades. When we plot an 80-week moving average on there, that depicts the bull and bear market cycles the market has gone through. Beyond some short-term noise where we temporarily broke above that and below that line, we now are distinctly trading above that, which clearly continues to depict a bullish cycle within the stock market. We obviously have on the daily chart some technical observations to comment on that, but really at this stage there is no weekly chart indication of some sort of a bear market or anything. So when we take a look at the S&P 500 on the daily charts, we depict some different overhead resistance levels that we've been observing. Obviously, the stock market has gone through an extremely bullish push. Just right in here, we've marked off the upper end of the zones of where numerous measured moves and technical targets suggest. Now we've tested there. There was an attempt to reverse. That simply has not grabbed at this stage. The market is, even as we speak, is trading above the 1400 level. That opens the window for this to even potentially not only retest its highs at 1410 or so, but we could certainly see a push right into the overhead resistance targets around that 1420 to 1440 on the upside. Overall, the process of the market reaching a short-term high is exactly that, a process. And so we're going to have numerous tests of this, whether it's double tops or head and shoulders patterns or any other type of thing. There's going to be some sort of kind of indication along the top that the bulls have run out of some sort of momentum. At some juncture, an inevitable market correction will ensue. They always happen. The average market correction has been about 8% in the last decade, which means that wherever these short-term highs bang out, we could have even up to 100+ S&P point correction on the downside off that. It could take even a month to play out. That does not make it a bear market, nor does it make it a crash. It's just a market correction that always follows a substantial advance in the stock market. So really, while on the short term we could see some strength even up to the 1420 to 1440 level on the upside, more than likely it's just going to be the market finishing and banging out some sort of short-term highs, and we're probably within weeks of seeing some sort of a very healthy market correction that will create a buying opportunity. So when we take those intermarket observations and we take a look at our bigger picture stance, we actually remain neutral on the short term of the US dollar, because we clearly have not seen a commitment on the bullish side nor a commitment on the bearish side of that dollar in the short term. So we're very range bound. In the bigger picture, we believe a substantial bottom has been put in the US dollar, and therefore at some stage we will see the US dollar go through another strengthening cycle on the upside as a part of our 2012 forecast. And we're waiting to see how that plays out. But again, on the short term, there's no indication that that has actually begun. In the same regard, on commodities, which have already had a really good run, other than oil, which has the potential to be a little more bullish, a lot of other commodities are far more neutral, as they have run their course very much. In the bigger picture, if we are bullish the US dollar, we could see continued weakness in commodity prices, and that's why we remain long-term bearish, but that's very much founded on our US dollar bullish theme. In the same regard, while bonds have corrected, we've not really ever turned short-term bearish bonds, even though we've targeted some of these lower levels for testing on bonds. We believe that as soon as bonds finish this sell cycle, it will actually represent a buying opportunity in the bigger picture. And so we are looking at more neutral on the short term on bonds, but we'll be actually buyers of bonds after this correction has run its course. In the bigger picture of the stock market, we don't want to take a stance that we believe some sort of imminent market crash or some very bearish scenario plays out. In fact, we simply believe at this stage that the stock market is approaching the upper end of its trade range for this early part of the year cycle. Now, after some sort of sell in May and go away cycle, we probably are going to see some sort of a substantial market correction, which at some later point will be a buying opportunity as well as on the short-term correction. So really we're just more or less remaining neutral, as we feel that there's very little upside potential on the short term without there first being a market correction. That was your Monday Futures Market Outlook. Thank you for joining us.